It is always difficult to determine previous standard cost. When the actual cost exceed the standard cost, okay, no doubt, so the difference term as unfavorable or debit variant or adverse we can say. The current standard are three types. Okay, the first one ideal standard, expected standard and normal standard. Consistency of standard. The consistency level is very important for when you are applying. Hello everyone, a warm welcome to one and all. I am Natesh, lecturer in commerce, Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. We are in the Unit 5, Session 9, 4th semester BCom Costing Methods and Technique. The chapter name is Budgetary Control and Standard Costing. Limitation of standard costing and preliminary of establishment of standard cost system and the variance analysis. Okay, in the last session, which is related to the advantages part, I have covered. Okay, and so the limitation, obviously the standard costing when the company organization they want to implement or establishing. So obviously there are too many disadvantages or drawback we are finding here. The first one, costly system. Okay, because the standard costing the company are implementing, obviously the cost is increasing. Because the standard costing require high skillful and complete personnel, because at the time of preparing a standard costing, okay, those who have any idea or expert, so we are always depending for the person, those who are having a complete skill about the standard costing, because which is a guiding for the management. Okay, so you have to take a proper decisions. Okay, proper planning is required. It become a costly system too. For same expert are paid high remuneration. So if the cost accountant, if they are try to implement the cost accounting standard costing system, obviously the cost is incurred, because the person's skill is very important to do the standard costing here. And the second one, difficult in fixation of standard. Okay, there is actually how your which is not flexible. So obviously if you want to adapt the standard costing, so there is some difficulty we are finding here. It is always difficult to determine previous standard cost. Okay, so that's what the major of the many company they are trying to go do for the standard revising. Okay, the cost what you are setting, so they are trying to divide in a given situation or conditions, okay, which will coincide with the actual cost when the operations are over. Okay, so here the majorly we are talking, so when you are producing a product, okay, which is completely for unique product means, okay, the standard costing is not advisable. Okay, so in case of manufacturing, the cost is keep on the timely which is varied, right? So obviously the standard costs are determined partly by the past experience, whatever we have complete the record, whatever we have. So based on the past experience, we are trying to set a standard. Or partly to the cost projection. So because any costing will be always dealing for how to control the cost, how you can project the cost. Based on the advanced statistical technique, so thus uncertainty revolved around the standard. So obviously there is a statistical tools are implemented. Okay, the most of the company they are trying to take a proper decision. So here we are talking related to assumption or hypothesis. Okay, so next one, constraint for the service industry. So which is not at all advised for the service industry, because each and every time the services keep on changing. So the standard what we are setting for the service sector, which is not advisable. The standard costing is applied for planning and controlling and manufacturing a cost. Okay, what and all the which is related to the manufacturing product, either material or labor or overheads or direct expense. So everything, the standard costing which is always applicable for the manufacturing okay, industry, so not for service sector. Thus it cannot be applied for the service industry. And fourth one, consistency of standard. The consistency level is very important for when you are applying. So obviously because the standard of margin costing fluctuating, margin costing is fluctuating, which is based on the additional. Okay, so we are trying to go for change modification. So here the once you are setting a standard, you have spent for the time consumption. Okay, so the valuable time is very important here. The vary time to time. Okay, so that's what the marginal costing, which is completely varied. But in case of standard costing, which is not once you fix, you have to follow that same. It is difficult to always sustain and continue to the same standard. It's not possible because see there is a lot of materials value, labor cost also increasing, other overheads, unpredictable nature, right? So unsuitable for non-standardizing product. So in case of standardizing product, of course we can predict there is a the standard material how much okay, and standard labor how much is required, even the overheads what and all involved for the production process. But unstandardized, be each and every product which is a unique. So because we are talking related to unstandardizing. So the standard costing is expensive and unsuitable for job manufacturing industry. That means each and every job is unique. So obviously the standard costing is not advisable. So as they manufacture non-standardizing products such as catering, tailoring, printing, etc. Too many examples for each and every job is unique. And relatively fixed standard. So what exactly the relative fix of standard? So either you are comparing with the materials or labor or overhead. So obviously we need to consider for all the, okay, a business may not be able to keep standard up to date. Okay, the standard cannot be revised again and again. So in other words, a business may not revise standard to keep pace with the frequent change in the manufacturing condition. So according to condition, if there is any chances to modify the standard, so frequently we cannot modify. So again, we can revise, which is a revised standard, so which is long period. Okay, so firm may avoid revising standard as is costly affair, because whenever you are revising, obviously the skilled person you have to invite. Okay, so obviously the labor which is talking related to the standard revise, which is talking related to the material revise. Okay, so we will get more clarity of next one. Preliminaries of establishment of standard costing system. If you want to implement the standard costing system in your organization, so there is something like you need to set some standard here. So the following 4 points are usually considered for setting up a standard cost system in a business. The first one, setting up a cost center, either which is a person related or department wise or machine running. So the cost center is playing a very important role here. And the classification of account, we need to track each and everything which is based on the material, labors, obviously. Okay, and even the types of standard, what kind of standard, the types of the, basically we are talking current standard or in current standard. You in coming slide you will get more clarity. And next one, setting the standard. Of course, once you selected the cost center and the classification of account and the codification is done, obviously we need to refer the types of standard, which one. And next one, setting the standard. Once you selected, obviously the first one, setting up cost center. A cost center is a location, maybe location or people or item or equipment or machinery or department. So section, okay, for a cost may be ascertained and used for the purpose of cost control. So everything, the cost account, which is completely talking related to the control of cost. Okay, so obviously which is given by the definition International Certified Management Account, London. Okay, so moving forward, next one, classification of account and codification is very important, because if you want to test for any account with the help of trials, which is not at all advised, so that's what the accounts are classified in order to the assist collection and analysis. We need to collect the data which is related to material factors, which is related to the labor factor or overheads, so what and all which is connected to your manufacturing, your final product. And the next one, types of standard. So basically the types of standard can be classified into majorly two types. One is a current standard, which is a long period. So the basic standard, what you are setting a basic standard. So there are two types. One is current standard, which is always for going for the trend, okay, the conditions. So the current standard, this standard are revised at regular interval because again we have a complete freedom to control. Okay, so we have a complete freedom to go for revising. So that is the basic standard, which is always with the intention for long period, but current standard will be always according to the situation, conditions. Again, revising easily done. The current standard are three types. Okay, the first one, ideal standard, expected standard, and normal standard. Okay, moving forward, the first one, under current standard, the ideal standard, this is a hypothetical. Hypothetical means what? Which is an assumption. Okay, so hypothetical standard, which is a rather not practicable to attain. Okay, so based on the assumption, whatever you are trying to assume based on material factors or labor factor or overhead factors, this ideal is clearly unrealistic and unattainable. So based on the assumption, if you try to take any proper decisions, maybe can be which is giving a proper result or not giving a proper result. So because only for assumption based. Now expected or practical standard. So how much you are expecting? Okay, so how based on your expectation and practical standard, so such standard are likely to be expected utilized in the future period. So in future, how much you can expect the sales? So that's what we are trying to do for the sales variance. Okay, so we are talking related to the standard costing. Obviously, we need to expect the result. So it is most generally used to standard in the best suited for the cost control. So which is always you need to study based on the cost control. Next one, normal standard. It is known as a fast performance standard, which is already we have a track on the fast performance. Okay, so because it is based on the average performance in the past, so which is already the work is completed, we have a track of records. So based on the performance, we can try to go for the normal standing. So it should be attainable and it is provided to challenge to the staff. So obviously, which is giving a proper record. So because we are referring for the next taking decisions. Okay, and next one, basic standard. The sentence only, which is very clear to understand here. This is a standard which is established for use unaltered for an undefined time. So we cannot alter whatever you are setting a basic standard which is followed for the certain period. Okay, so moving forward, the setting the standard. Once you identify what types of standard, immediately we are going for setting this standard. The standard set for the following items are, one is based on the direct material standard. Okay, so always we are comparing with the direct standard with the actual. Okay, and direct wage cost or labor, and the direct expense base, the factory variable over its cost, selling and distribution variable, and selling price and sales margin. So in the coming section, you will get more clarity about the variance related. So obviously, there are different types of we can identify here. So we are setting a standard. And next one, the standard for material. How much you are setting the standard for the material, about the material quantity, the standard for labor hours. Okay, the standard labor hours. And the material price, what is the maximum price or minimum price you are fixing standard. Okay, and the setting for overhead standard. Okay, so there are different types of standard which is coming under the administration, maintenance, or selling and distribution. Okay, so next one. Next, variance analysis. So we will get to know the standard minus actual, which is nothing but your variance. Okay, so the process of analysis variance by subdividing total variance. Okay, so all together. So we are talking completely focusing on the manufacturing. So which is producing a homogeneous product. Okay, so which is in such a way that the management can assign responsibility for of standard performance. So unless you're not setting a standard for the respected department, respected individuals, those who are involved in your production process, so obviously the standard performance you're expecting, so which is always comparing with the actual performance. Interpretation of variance. So obviously, once you get the difference between the standard as well as actual, so we need to interpret properly. So each variance is interpreted accordingly, and interpretation we mean taking a decision of whether the variance is favorable or unfavorable, or attaching to the responsibility, because in the company, in the organization, everyone is equally important. So we are completely focusing on the manufacturing. So because the productions related, the cost control we are trying to ascertain. So obviously everybody's responsibility, that's what we are setting a standard. So the standard is always comparing with the actual, so then only we are finding the difference here. When actual cost is less than the standard cost, very important point here. The actual cost is when it is less than the standard cost, the difference which is called as a favorable or credit variance, or we can say just we are writing symbolical after whenever you are doing a problem F, okay, which is giving a favorable. So in case, in the other hand, when the actual cost exceed the standard cost, okay, no doubt, so the difference term as unfavorable or debit variance or adverse we can say. Okay, and ordinarily a favorable variance is a sign, okay, favorable which is always talking related to the efficiency, okay, efficiency of the organization, whereas unfavorable variance is a sign of inefficiency because the standard which is not matching with the actual, okay. So the division of variance into controllable and uncontrollable, obviously if there is any deviation or more difference we are finding, so which is coming under the controlling or not controlling. So important from the viewpoint of management, as it can place more emphasis on the controllable variance. So obviously they are focusing for the controllable variance because the completely the management have a control to okay, so if there is any changes is required, obviously they can do. So thus the facility is the principle of management by exception. Okay, so obviously we are expecting a standard which is always comparing with the actual. Keep on watch for next section. Thank you.